Hello, everyone. Thank you for joining this podcast or this webcast by Altfest Personal Wealth Management. My name is Carolyn Yun. I'm a CPA as well as a CFP, and I do a lot of the tax planning and tax strategy for our clients here at the firm. I want to thank you all for joining. I want to take a moment to thank the Society as well as the Executive Director, Babette Edkins, for allowing us this opportunity to present today. Today's webinar will cover a lot of tax reduction opportunities, both for individuals as well as practice owners. To give you a little bit of background on Altfest, we were founded back in 1983, and we currently manage about $1.3 billion in investments for our clients. We are a fiduciary and a fee-only firm, and we provide comprehensive investment management and financial planning advice. So this year presents a very unique tax planning year. Overall, what we're seeing is that surgeons who work for practices or perhaps run their own practice, they're seeing that their business income is down this year. There's been increased costs related to purchasing personal protective equipment. There's increased cleaning protocols this year. And we're also seeing that a lot of our self-employed individuals are having staffing shortages as employees switch from full-time to part-time employment. So overall, we're seeing that business income is lower this year. On top of that, surgeons who work for maybe hospitals or large practice groups, they're also seeing that wages are down this year. So overall, from a tax planning perspective, we're seeing that earned income is lower this year. On top of that, we're seeing that companies are cutting dividends, interest rates are lower this year, and capital gains distributions are also expected to be lower this year. Overall, this entire picture is kind of presenting a very difficult financial constraint this year, but on the other hand, a very interesting tax planning opportunity. So what we're going to be talking about a lot today is how can we accelerate income this year to actually capture some low tax rates that are available to either you or some of our clients are seeing this year. The first item that we have to bring to your attention, this is new for 2020. It's also referred to as an economic relief payment or a coronavirus stimulus rebate. It's a refundable tax credit specifically to your 2020 tax return. This would be worth $1,200 for individuals or $2,400 for joint filers. There's an additional $500 per qualifying child. There is a phase out, however, so if your adjusted gross income was above $75,000 for individuals or $150,000 for joint filers, you would not be eligible for this rebate. If your AGI met those thresholds in 2019, you would have already received this credit in the form of a payment. However, if you find that you either became unemployed this year or have significantly reduced income, you may find that you're now eligible for this credit by the time you file your 2020 tax return. Another huge opportunity that we're having this conversation with almost all of our clients across the board is whether or not 2020 becomes the year of the Roth conversion. So, we've spoken about how overall we're seeing reduced income this year, which means our clients and perhaps you are now in some of the lowest applicable tax brackets that you're going to get exposure to in the coming years. On top of that, we're seeing low tax rates in the marketplace from a historical perspective. And then lastly, and most importantly, during this COVID pandemic, we've seen federal, state, and local budget deficits skyrocketing. So with all likelihood, we do expect some form of tax increases in the coming year in order to cover the government spending, the excess government spending we're seeing today. This kind of presents a really interesting opportunity, and on the screen right now you'll see something we do for all of our clients here at the firm. We run their tax projections for every year of their financial plan. So it's not just one, how do we save taxes today, but two, how do we save taxes for our clients over their lifetime tax obligation. Here is an actual example of a dual income married couple here at Altfest. They are both physicians. They're currently working. They're in their late 40s, early 50s. And you can see that their tax obligations slowly increase as they continue through their working years. Shortly before 2040, one of those clients retires, their tax obligations decrease. Shortly after 2040, the second client retires, they enter their retirement years. You can see that there is a lull in their tax obligations before they start Social Security, as well as required minimum distributions from their pre-tax IRA accounts. And as you can tell, as they go into their retirement years, they're actually going to start to get pushed into higher and higher tax brackets than they were in their working years. And one way that we can kind of avoid this, delaying taxes for too long in pre-tax assets is by taking pre-tax savings and making them into Roth savings. Roth IRA accounts are so valuable for your overall tax planning because, one, they are after tax dollars, meaning anytime you take a distribution, there is no tax, they're non-taxable. And two, because there are no required minimum distributions, they're not forced to take money out of these accounts into your retirement years. So when we sit down with clients and we do their overall tax planning, we want to encourage them to establish 3 different buckets: a taxable bucket, a pre-tax bucket, and a Roth IRA bucket. So this is an example of where perhaps our clients are saving too much in pre-tax assets, and they could really get a lot of value out of putting savings into Roth assets. And when we look for low income years, that's really when we try and take advantage and do IRA to Roth conversions to capture those low tax brackets and set that money aside into a new kind of tax diversification bucket. So there really are 3 main strategies when you're trying to generate Roth assets. The first is converting an IRA to a Roth IRA. The second is to switch your 401k contributions from pre-tax to Roth contributions. And the last would be to perform backdoor Roth IRA contributions if you are phased out of making direct Roth IRA contributions. Now, the one we're going to focus on today is the most powerful one, which is the first one. The second 2 have limits in terms of either income phase outs or the specific dollar amount that you could contribute to these accounts. The top item, doing a conversion from an IRA account into a Roth IRA account, is the most powerful because there's no income phase out and there's no limit on how much of a conversion you can do. So let's start with an example. When we talk about doing Roth IRA conversions with our clients, this is how we might go about looking at calculating the dollar amount to convert. And what we're talking about here is how do we fill up specific tax brackets. On the left-hand side of your screen, you see the 2020 federal marginal income tax brackets. If you are someone that also has state income tax as well as maybe city income tax, you're going to want to also consider those additional brackets when doing a Roth conversion analysis. But for simplification purposes, in this example, we're just looking at the federal brackets. So we have a client that in 2019 and previously made around $320,000. This year, because of the pandemic and significantly reduced income, they find themselves in the $112,000 range. They've now gone from the 35% marginal income tax bracket, and they've dropped down to the 24% marginal tax bracket. So when we have a conversation with them, we might say, given how much income you've made today, you might look at filling up to the top of the 24% tax bracket, and that would be around $50,000 for them. They may come back and say, you know what, we're comfortable going into the 32% tax bracket. In that case, we look at the next bracket and we say, well, we don't suggest that you convert more than around $88,000, which would push you to around $200,000 for individuals or $250,000 for a married couple. Then there's a reason for that. And the reason being that in addition to your kind of federal marginal tax bracket, there are other sort of thresholds where you could trigger tax surcharges. And we want to make sure that you're aware of a very important one. The first one being, if you have adjusted gross income of $200,000 for an individual or $250,000 for a joint filer, there's 2 additional taxes that apply. The first is the 0.9% additional Medicare tax, and that is applied to earned income above these thresholds. And the second would be your 3.8% net investment income tax, which is applied to your investment income, so passive income sources you could think of, and it's above these thresholds. So The 3.8% is actually applied on top of your capital gains rates. The additional Medicare tax is applied on top of your ordinary income rates. So knowing that you could trigger this threshold, we generally try to manage our clients' conversions to stick below sort of anything that would cause sort of tax surprises on their ultimately filing their tax return. Now, there are ways to actually do Roth IRA conversions, convert more without triggering as high taxes. One of the most significant and beneficial ways is if you have a traditional IRA account that has something called a high basis. Let's take an example. Let's say we have a $500,000 IRA that consists of $400,000 of non-deductible contributions. This means that a client who has been phased out of making direct IRA contributions has diligently been making the maximum they could make contributions into their IRA, but they've been claiming it as a non-deductible contribution. What they've been doing over a period of time has been establishing something called basis in their account. This is a non-taxable part of their account. On top of the basis, you'll see growth on the contributions. So now the IRA consists of both basis, which is non-taxable, and growth, which is pre-tax, and that is taxable. When you convert an IRA to a Roth, and you have an IRA that has both of these components, only the piece that is growth is taxable. So if you have high basis in the account, you could convert this $500,000 IRA, but only 20% of that conversion would be taxable. Now you may be wondering, prior to doing the conversion, is there a way to separate the basis from the pre-tax growth? And there are two methods. The first is if you take the pre-tax component and roll it back into a employer-sponsored qualified retirement plan. And that's because traditionally those types of rollovers only accept pre-tax dollars. The second would be if you are in your 70s and already taking required minimum distributions, you could do something called a qualified charitable distribution. This is when you take your RMD, you gift it directly to a qualified charitable organization, and that donation is completely tax-free on your tax return, but you do not also get the deduction for the charitable donation. However, QCDs are only performed with pre-tax dollars. So that's another way to strip out the growth component from an IRA prior to doing a Roth conversion. The other way that we might talk about doing a more powerful Roth IRA conversion is if you have either net operating losses from a business or if you have charitable deduction carryforwards. These two items can also allow you to convert more into a Roth by shielding some of the taxable income you're generating. Let's start with an example. Assume your spouse earns around $70,000. You expect interest and dividends this year of around $10,000. Your business has a loss of $200,000 this year. You can now essentially do a Roth conversion and net out your tax obligation to zero this year. Very importantly, under the CARES Act, there were a number of important changes that we're going to discuss in a few slides, but I just want to clarify here. The CARES Act changed certain rules that now it suspends excess loss limitations. And in addition, net operating loss carryovers are not limited to 80% of taxable income anymore. So that actually makes these Roth IRA conversions even more powerful today. All right, there are a number of ways when doing a Roth conversion, you could trigger unintended tax surprises. So I want to make sure it's very clear in this presentation that one, generating a Roth conversion or doing a Roth conversion creates taxable income. It's very important that you know that. Two, it also is not reversible, so you cannot undo it once you've done it. So very important that you remember these two items prior to doing a Roth IRA conversion. I definitely recommend you running the scenario through with either a financial advisor or your tax preparer to make sure you're not going to be triggering any of the items I've listed here. Because I want you to know that if you generate taxable income, you could be triggering some of these additional items. One, it could impact the ability to get the coronavirus relief rebate if that's something you're expecting to receive this year. Two, you could be triggering higher capital gain or qualified dividend tax brackets. 3, you could be phasing out of the 199A qualified business income deduction, which is a 20% deduction. 4, you could be increasing the taxation on your Social Security income from, say, 50% taxable to 85% taxable. And lastly, you could be increasing your Medicare IRMA surcharges on Medicare Part B or Part D premiums. So if any of these scenarios apply to you and your situation, you're going to want to know how much you can convert into a Roth without triggering any of these sort of unintended tax consequences. Again, in our theme of we're in a lower income year, how do we accelerate income to capture some of these low tax rates that we're seeing in the environment today? When we look at portfolio management for our clients, we look at their taxable investments, and we look at crystallizing capital gains to fill up some of their capital gains brackets. We do this by selling and also repurchasing shares to give them a step up in cost basis so that they're paying taxes today, and when they need to go and sell that investment into the future, when they're at higher marginal rates, they're kind of selling a smaller gain in the future during retirement. There's been a number of other rule changes that have come about this year. One was a gift to parents. So Kiddie tax rules have changed under the Secure Act. This applies to parents with children under the age of 18 or those that have full-time students aged 19 to 23. If they have unearned income over $2,200, your unearned income, again, is your passive income sources. So you could think interest or dividends or capital gains distributions. Prior to this year, in 2017, there was a rule change that taxed unearned income for children at trust rates. That very quickly allowed children who earned more than around $12,000 or $13,000, they were pushed into a 37% marginal tax bracket because trust rates have very compressed marginal brackets. This had unintended consequences for the children of deceased military personnel, so there was a lot of pushback in Congress, and the rule was reversed, and now we are back to being taxed at your parents' marginal tax rates. So this is a gift for parents that have kids with unearned income sources. There's also been a number of rule changes for 529 plans this year. The first being that 529 plans can now pay for student loan principal and interest of the designated beneficiary or the beneficiary's sibling up to a lifetime limit of $10,000. So if you are new into the profession, you are still paying off your student loans and you have a 529 plan or your parents have a 529 plan still in your name, you could use some of that to pay down student loans now. Or if you are a parent with young adult children and you still have some balances remaining, you could look at giving them a little bit more relief this year. On top of that, employers are now eligible to pay $5,250 of an employee's student loan directly. These payments are completely tax-free, they're excluded from income, and no FICA taxes apply. And, just a kind of tax item, but also a financial planning item, just to make sure that you're aware, there was an executive order signed earlier this year that suspended payment and interest on federally held student loans until December 31st of this year. So, student loan payments are not tax deductible. We always encourage you to take advantage of paying those off at a reasonable rate. There were some other changes this year for retirement plans. So the first was under the Secure Act. So first, it repealed the maximum age for IRA contributions. It is no longer 70 and a half. So if you are over 70 and you are still working, perhaps you have suppressed income this year, you may actually be eligible to make IRA contributions again. You may not be phased out. Something to look into if that's your particular situation. On top of that, there is RMDs now begin at the age of 72. They no longer start at 70 and a half. So Congress had never sort of accounted for the fact that we are seeing longevity increases, and now they're kind of pushing that age back to account for that. On top of that, and one of the most significant changes that we saw under the Secure Act was that it eliminated the ability to take stretch IRAs. So in the past, if you inherited an IRA and you were a non-spouse beneficiary, you had to take required minimum distributions over your lifetime. The new rule, if you inherit an IRA this year in 2020 or going forward, and you are a non-spouse, you are now required to take 100% of the proceeds out of that account within 10 years following the year of death. So it's very important that you kind of take into consideration if you inherited an IRA this year and you're now required to take it out over 10 years. You should consider, if you have suppressed income this year, if it makes sense to take a larger distribution from the account this year and maybe smaller distributions into the future. On top of that, we saw a number of changes under the CARES Act this year. So it eliminated the requirement to take RMDs for 2020. So if you are someone that does not need your RMD for cash flow purposes, we certainly encourage you to keep that invested into your accounts, and there are no tax consequences for doing so. In addition to that, there's a new rule change for penalty-free withdrawals from IRA accounts this year. It's called a coronavirus-related distribution, a CRD. You can remove up to $100,000 either at one time or multiple times, but in aggregate for 2020, the distribution cannot exceed $100,000. There would be no 10% early withdrawal penalty on that distribution if you had not yet met your age of 59 and a half. And it's very interesting for some of our early retiree clients. We've had a discussion with them about taking this distribution penalty-free and kind of reinvesting it into a taxable account so they can use it sort of for cash flow purposes before they get access to more of their account once they turn 59 and a half. Just something to be aware of, though, is that this is ordinary income. When you take the distribution, you do owe taxes on it. However, you're not paying the early withdrawal penalty. You can actually prorate the taxes that you would owe over 3 years because you can claim basically a third and a third over multiple years. You can kind of just set up the distribution. You can take the distribution this year, but set up the tax requirement over 3 years. All right, so when we talk about charitable planning this year in a low income tax year, theoretically, really, it doesn't actually make sense to make charitable donations this year. When you could wait to January 1st of 2021, you could use your charitable deductions to offset higher marginal tax rates in the future. However, there are a lot of people in need this year, and that should not discourage you from making charitable gifts. There are a number of new strategies available under the CARES Act. The first is for those that use the itemized deduction. There's a new charitable deduction limit this year. You can deduct 100% of your 2020 AGI, which is up from previous limit of 60%. This does not apply, however, to any donations directly to a donor-advised fund. For those who, on the other hand, take a standard deduction, there's a new sort of universal above-the-line deduction available. This is when you give cash of $300 for individuals or $600 for joint filers. If you give cash directly to a charitable organization this year, you essentially get a little bit extra on your standard deduction. There is no income phase out. There's no restrictions on that as well. But the contributions don't apply for anything made to a donor advised fund or a non-operating private foundation. On top of the fact that there were some changes this year related to required minimum distributions, given that under the CARES Act, you no longer have to take them, we want to just clarify, if you're interested in doing a qualified charitable donation, you are still eligible to do so. There are no changes to kind of that strategy, even though you don't have to take an RMD this year. On top of that, just a new item we've seen introduced by the IRS this year is that they now permit something called a leave-based donation program. Employers can make charitable donations for COVID-19 victims based on the value of either sick, vacation, or personal leave that an employee voluntarily forgoes. So the employee does not have compensation and avoids FICA taxes by making this sort of donation, and the employer can deduct it as ordinary and necessary business expenses. We're going to switch gears a little bit and talk more about strategies for your surgeons who maybe own your own practice or are self-employed. When you're entering the last quarter of this year, we really encourage you to consider looking at sort of decelerating your business expenses, because again, they can offset higher marginal rates if you wait to make the deduction January 1 of 2021. So obviously, pretty straightforward. We're encouraging our clients to get invoices paid, collect accounts receivable during this sort of low income year, but also avoid holding off on any investments in perhaps new telehealth infrastructure or upgrading equipment, making that investment next year. Another item that is becoming a discussion point is whether it makes sense to switch from the accrual method of accounting to the cash method of accounting to defer taxes. So you really only owe the IRS money under the cash accounting method once the invoice is paid. So it's a little bit of a way to kind of defer taxes, at least temporarily, when you're trying to do cash flow management for your firm. This really relates to a rule change that happened in 2017. Now, small business taxpayers with average annual gross receipts of $25 million or less in the prior 3-year period can now opt for the cash accounting method over the accrual method. So, some small businesses may actually now see they're eligible going forward, and it might be something they're worth considering. One of the most significant tax planning items that we're really having a conversation with our business owner clients is how claiming 2020 losses on prior tax returns can actually get them some cash flow relief this year. So under the CARES Act, it now allows 100% of net operating losses for 2018, 2019, and 2020 to be carried back to the prior 5 tax years. The prior rule was subject to an 80% of taxable income limitation, and that limitation no longer exists. So now you have a lot of flexibility to use your 2020 losses, file amended returns for prior years, get refunds for those previous taxes that you've paid, and now have more cash flow available for this year to hopefully, give you some relief if your business is struggling to meet cash obligations. There have been a number of different payroll tax deferral items mentioned this year. I'm going to be very clear. There's 2 that we're discussing on this slide. The first is under the CARES Act, which is employer 2020 payroll tax. And we will discuss also the employee payroll tax deferral, but these are 2 separate items. The first under the CARES Act was that employers in 2020 can delay their payroll taxes, so that's 6.2% for Social Security. 50% is due December 31st of 2021. The remainder is due December 31st of 2022. This deferral does not incur any interest or penalties. It also is available for those who are self-employed, and we're certainly encouraging all of our business owner, self-employed clients to take advantage of this deferral, at least for cash flow purposes. On the other hand, there was an executive order signed earlier this year that allowed an employee payroll tax deferral for those who make less than $4,000 pre-tax on a biweekly basis, or the equivalent with respect to other pay periods. It would be wages paid from September 1st to December 31st. That deferral on the employee portion would be due 100% in the first quarter of 2021. For our business owner clients, we are very much discouraging them from offering this to their employees, because at this point, if the employee were to leave that company, the employer would then be responsible for paying that entire tax deferral that was not collected. There are also some payroll tax credits that were introduced under the FFRCA Act earlier this year. So if you are an employer with less than 500 employees, you are now required to provide paid family leave and paid sick leave. However, there's eligible payroll tax credits to sort of offset the costs of providing this program. If you're self-employed, you also qualify for these tax credits. However, if you are an employer with less than 50 employees, you can be exempt from the requirements. So let's start with the paid family leave requirements. It is a 12-week program. 2 weeks would be unpaid. The 10 weeks you would be required to pay would be for a qualified employee. The amount of the tax credit would be 100% of wages, but limited to either $200 per day or $10,000 in aggregate to one employee. The eligible wages are April 1st, 2020 to December 31st of 2020. Then any wages paid in this period under this program would not be subject to your 6.2% employer Social Security tax. For the paid sick leave, you would have to provide 2 weeks of pay to a qualified employee. And then the amount of your credit really depends on the reason why the employee is unable to work. But generally, it's the greater of either 100% of wages limited to $511 per day or $5,110 in aggregate to one employee, or 2/3 of wages limited to $200 per day or $2,000 in aggregate to one employee. If you have questions on how this payroll tax credit might apply to you or your situation, I would definitely encourage you to reach out to your tax preparer. They can provide more guidance on if you are a qualified employer and what a qualified employee is. On top of that, there is a second new sort of credit we're seeing this year under the CARES Act. It's called the Employee Retention Credit. If you are an eligible employer, if you either partially or fully suspended operations during any calendar quarter in 2020 due to COVID, or if you experienced a significant decline in gross receipts this year. You cannot, however, claim this credit if you received but did not return a PPP loan prior to May 18th of 2020. And then there's a big difference in the amount of credit you can claim under this strategy. If you had more than 100 full-time employees in 2019, then only the wages paid to people not to work would be included. If you had less than or equal to 100 full-time employees in 2019, you can include wages paid to all employees regardless of whether they were working or not. The amount of the credit for this employee retention credit are your employment taxes equal to 50% of qualified wages up to $10,000 in wages for each employee. So that translates to a maximum credit of $5,000 per employee. And the wages that are eligible would have to have been paid between March 12th of 2020 and January 1st of 2021. So again, if this is something that you think may apply to your situation, definitely speak to your tax preparer about it this year. All right, so lastly, we've had a lot of conversations with our clients about either one, are they interested in selling their practices? Are they interested in an early retirement? Are they passionate about continuing working during this pandemic? And we really could do an entire presentation on this topic alone, but to give you sort of high-level guidance, if you're looking at selling your practice this year and you have sort of an unprofitable practice, you would see some relief under IRC Section 1244, which allows you to use up to $50,000 of net losses or $100,000 for joint filers to offset your ordinary income this year. So again, remember that capital losses, you can only really offset $3,000 a year, but in this case, if you have a small business, and this covers only domestic shareholders, so your C Corp or your S Corp, it doesn't apply to partnerships. But you would see a little bit of tax relief by selling at a loss. On the other hand, if you're looking at selling a profitable practice this year, you want to look at IRC Section 1202, which allows you to exclude from gain either the greater of either $10 million or 10 times the adjusted basis of your stock, owned for at least 5 years, as long as the business did not have assets greater than $50 million. So this is a very large and handsome tax shield for qualified small business owners. It's definitely something to have in your mind when you're considering selling a practice in the future. All right, well, today that really wraps up the bulk of today's webinar. Tax planning is very nuanced and there's a lot of new tax rules and changes this year that we hope we brought to your attention and you found interesting. Tax planning is really just one component of what we do for our clients here at the firm. And you can see on your screen that we offer kind of a number of different areas where we do planning in addition to just investment management. If this is something that you're interested in having a conversation with us, up here on your screen is the contact information for Jessie Frayling, who would be willing to give you guys all a complimentary consultations if you want any questions answered on your financial situation, or if you want to speak to us in more detail. Please take a moment to take down his information and he'll be reaching out to you. With that, I just want to thank everyone, particularly the Society and Babette Atkins again for allowing us to present today. We hope you enjoyed the presentation.